Home buyers are getting more and more skittish. Sellers are getting really, really worried about selling their property. Are interest rates destroying the U.S. housing market? That, my friends, is the question that we are going to answer today. Let's go. Well, hello again. This is Erik Brown, your Beverly Hills real estate agent, sharing with you the best and brightest that Beverly Hills, Los Angeles, and the housing market has to offer. I wanted to share with you today a little bit of insights about what's happening with interest rates here, as it's been an ongoing conversation over the past several months, and let you know what's happening with real estate because of this spike of interest rates. Now, as always, I'd love to help as many people as we can, and we've got the great honor of being able to assist dozens of families every day with their home buying, selling, and investment decisions. And so if you have any questions, if there's some video that you want us to be able to share, if you just have comments, please go ahead and hit that like button, smash subscribe, and we'll share with you all of our other videos that we create, as well as things that are going to be relevant to you. We're here to be a helpful resource. With that being said, let's dive right in and talk about this big question of, are interest rates destroying U.S. real estate today? Now, the answer to that question is going to be dependent upon your answer to these three questions. So let's begin with question number one, and that is, can real estate be timed? As far as you buying a property and finding out when the bottom is, can you time real estate? And the answer is kind of yes and no. Usually what comes into valuations of property are not only the property itself, of course, condition, number of bedrooms and bathrooms, the square footage, the neighborhood that it's in, the size of the yard, the age of the property, etc., etc. But it's also going to come down to other items like trends or seasonality. And let's break those down a little bit. There's a difference when a market is trending, and that's where we're at now. That's the conversation that seems to happen most often. This idea of trending is going to be based on economic factors or political factors. And so with the economy that we're in right now, as there's discussions around inflation or around recession, that has a tendency to affect real estate values, but for a time. We have a tendency to see real estate doing this instead of just this, or instead of just this. And so it's good for us to understand where the market is trending and know how long it is trending for. Now, as a piece of that, we're also going to see that more in a micro market, we have seasonality. So there is oftentimes in US real estate a difference between selling in the summer and selling in the winter. So typically around the end of the year or around the holidays, you're going to see that there are less sellers selling, there are less buyers buying, for the really easy reason of they're busy with other things. They're taking time around the holidays or wrapping up the end of the year in their life or in their business. While in the summer, people are starting to think about more things of moving, because in many areas of the country, it's easier to move in the summer than it is in the winter because of weather. Thankfully, we don't have that issue here in the Los Angeles, Beverly Hills area, but I can understand that it exists. We also will see things like people planning around the school year. They want to move to be able to get into new schools if that is relevant to them. So seasonality and trends are two big things that revolve around this idea of, can the market be timed? Now with that, timing is important to also think about time in longevity. So if you're thinking about a home purchase as a 1-year thing, yes, it is a problem. If you're thinking about a home purchase as a 5, 10, 20-year thing, then no, absolutely not. Let's just look at recent history, and that was the recession of, give or take, 2007 to 2010. We have those 3.5 years, give or take, where the market generally was going down. And we saw on a national level that the market went down, give or take, 30 to 35%. Thankfully, here in the Los Angeles, Beverly Hills market, it wasn't quite the same. This area was a little bit more recession or economically safe. But in other markets, I totally understand that. The point is, what we're trying to share is that market for those 3.5 years went down. But look at the 4, 5, 6 years afterwards. It was robust appreciation. And the same thing happened here in Beverly Hills and Los Angeles. The market, even with a small dip, was really, really robust. this market generally doubles the national average for appreciation. And so if an average market across the US, homes will appreciate or double in value every 12 to 15 years, here in the Los Angeles area, it's every 7 to 10 years. So there's just a way that you want to look at kind of timing the market and what does time mean to you. Question number 2 that I like to ask, at least particularly for today, is should I wait until the market hits the bottom? And it's a really great question, and it's one that's probably asked the most that I have heard of. And it's people really want to time the market because they don't want to overpay. There's a fear for overpaying or driving down. Now remember the point that we just shared, and that's the fact that markets ebb and flow. So it depends on your timeline for that, but it also will be dependent upon your personal situation. We'll dive into the personal piece with our third question, but for now, when we're kind of diving into should I wait to hit this bottom, look at some of the factors that are coming into buying and selling decisions today. Supply and demand is a big one. In our area, supply is generally low and demand is still high. So even though it's more expensive as far as a monthly payment today, it has not really affected the amount of supply that exists. It has affected some demand. So instead of seeing multiple offers all the time, we're seeing less of that. But there's still a certain amount of buyers and there's a certain number of sellers. And if there's this many buyers and this many sellers, that generally means that buyers are still going to have to compete and sellers don't have to discount all that much. We also have the series of L's that are going to be expensive, and those are labor, laws, lumber. There's a number of the L's that are expensive. So lumber and materials, because of supply chain, continue to be expensive. And labor generally is not cheap. In fact, there are less people in the trades than there were a few decades ago. And so because of that, it's the same thing with supply and demand. We have this much supply of labor and we have this much demand for it. So builders can't really keep up. The laws revolve around the regulations that they have to follow for codes. And so for us to be able to build a volume more of housing, be it low income or lower cost or condominiums, there's a number of prohibitive laws potentially around zoning or around liability that could cause problems. And so having all of these things come into play and trying to time the market can be a challenge. And so you just want to make sure that as you're looking at the timing, look at all of these factors and what they mean on the marketplace. As I've said in another video, I think the buying market right now is phenomenal for a variety of reasons that we shared in the other video. So watch that one as well. But understanding that is going to put you in a position to be able to answer that question of, should I wait until the bottom? Also, as a quick sidebar, I wanted to share a quick math example to tell you about the marketplace today. Because I hear from so many buyers them saying, I want to wait. I just want to wait until interest rates go down or pricing goes down. And so let me give an example. In the beginning of 2022, when interest rates were at 3.5%, and if people got creative with their financing, it could be under 3%. I'm going to give an example of a $1 million property that you would put down $200,000. So in the beginning of the year, that means you had a mortgage for around $800,000, but you weren't buying it for $1 million because everyone was seeing multiple offers. So that property was going for 1.15 million. So your mortgage is no longer what you estimated at $800,000 because you were putting down $200,000. Now it's $950,000 or $900,000 or whatever the number may be. So when you factor in what your payment may be around that price point, plus you paid higher and you did not get any other concessions, you were at an original $1 million property that's now at a 1.1 or higher purchase price, which an interest rate of hovering in the 3s, let's say, and a $200,000 down payment, you're going to look around $4,000 a month for your payment. Again, at a higher price point than what you would have originally gotten. But you had a great interest rate. Now let's compare that to the market that we're in now. That $1 million property, still with $200,000 down, you might now be getting for a discount. So you might be getting it for $950 or $920 or $970, whatever is the number that you can negotiate with the seller. You might also get the seller to be able to negotiate or help you buy down some of the interest rate. And so if interest rates today are hovering around 6 or 6.5 or higher, let that ebb and flow. When you factor in all of that math, very similarly, you're still at around $4,000 a month. give or take. But you didn't compete, and you were able to get a lower price overall on the property. So that interest rate you want to be able to factor in as well as trying to chase down the bottom. Nobody can predict the future. And so if the market is great now, and yes, it could get a little bit better, but look at just what happened with the recession. Nobody predicted that to the level of detail that we saw. Of course, a few experts did, but you and I didn't. And so being able to time the market effectively is look overall at the strategy that is going to be best for you based on some of these factors. My last question is, for most people, what they ask is, what should I do? And that's a great question. And it's our third question, our final question that we want to go over today. And it's really, as I touched on a little bit earlier, it's dependent upon your personal situation. There are some markets where renting with rent control, like in New York or here in Los Angeles, that if you stay for a place long enough, rent's going to be really, really cheap. Now, rent can go up, and it's not stable or building an asset. I've always found that property ownership is a great way to build wealth, but you'll want to make sure that you don't have buyer's remorse. These are going to be things that are more personal, and it's not always just an economic decision. And so understanding what's best for your personal needs. It's also the idea of timing. If you are going to only be in a certain city for a certain amount of time, you may not want to buy unless you're going to turn that property into an investment property. But as long as you know that you're going to own for 5+ years, generally that's the amount of time to know that you are recession proof. The recession that we just had in the mid-2000s lasted about 3.5 years. So you get past that 3.5 years, which was the worst thing since the Depression of the 1920s and 30s. If you get past that, you know that the market continues to appreciate. Mind you, you always have to recognize as well that you continue to pay down the principal, so inevitably you will own that property free and clear. And as the market improves, will continue to appreciate again. Now you get that, plus you get the tax advantages of interest rate write-offs, and as we mentioned, some potential deductions if you're looking at investment property. There's just a volume of wins in owning, particularly as you own long-term. It's also really helpful to understand your individual financial situation. The example that I gave with the $200,000 down, you may or may not have that. If you've got a lot more, great. You're in a great position to be able to afford property. If you're not in that position, then you just look to buy a smaller property if it's still something of interest. But you want to put yourself in a position where you're going to be safe and successful. It's always good to save away for a rainy day. But we've talked enough about the advantages of real estate to know that it might be a good idea to be able to purchase depending on your financial situation. And it's always good to understand that there is a difference between waiting and being patient. Those are different things. Waiting and trying to time the market is a lot harder than being patient and finding a good deal for you in today's market. You can look at properties, you can get an understanding, you can even earn your junior real estate badge. And if you do that, especially with the help of a great real estate agent, you're in a position to be able to understand the market a little bit better, which will help you understand timing that works well for you. And that, my friends, is everything that I wanted to share about what is happening with interest rates today and if it is destroying real estate as we know it. My idea, and hopefully you've been able to tell by this video, it is not. We're just in a position of we are ebbing and flowing as the market has done historically in the past. Knowing the things that we talked about today will be able to put you in a position when you decide to buy or you decide to sell to take advantage no matter what the market looks like. As always, I love to be a resource. And so if there are other questions that you have, ideas that you want to talk about, go ahead and share some comments here. Subscribe and watch some of our future videos. We'd love to be able to help. As always, my team and I are one click away from helping you with your dream home goals. So touch base. My contact information is here. We'd love to be a great resource for you. And as always, I would love to take you home. This is Erik Brown, your Beverly Hills real estate agent, signing off.